Let me now make some comments about Australia. That 2015 column traces the Reserve Bank's growth forecast for Australia in that year. So the first one was in November last year, when they forecasted growth in 15 would be 3%. And the reason why they cut rates in February was that they realised that that 3% was not going to be achieved. And at the time, the Reserve Bank believed that you needed 3% growth to stabilise the labour market. So if they were going to have to substantially revise down their growth rate in February this year to a point that was well below trend growth and didn't do anything about policy, people would say that's irresponsible. And that's why, even though in December the Reserve Bank said a period of stability is the right policy, why they actually cut rates. And we identified that and called a rate cut, even though everyone was dismayed that having said rates for a period of stability was the right call, that they'd move as quickly as February. But it was clear that by the time they came around to making their new growth forecast, it would be well below 3%. So what they did was that in February they cut rates, but they were still only able to forecast 2.75% growth. And in May, they cut rates again and were still only able to forecast 2.5% growth. That's where we stand today, and I think that's probably going to be about right for this year, around 2.5%. At the moment, growth is only running around 2.2%, but we do expect to see slightly better numbers in the second half of the year. What about 2016? Well, a pretty similar story. And back in November, they said 3.5%. Then in February, they had to cut that to 3.25%. Then in May, down to 3.25%. They left it at 3.25%. But in August, they shaved it again to 3%. We expect 16 will be 2.75%. And that's about on the cusp of trend growth. Now, if there were a reason emerged to substantially lower that number, say next February, from 2.75%, say down to 2.5% or 2.25%, then they'd cut rates. They would have very little choice. At the moment, they've lowered their view on trend growth to 2.75%. So if you're growing at trend, it's reasonable to say that the unemployment rate will stabilise, and that's okay for the short term, as long as you can provide some hope for the next year. And at the moment, they're arguing that in 2017, growth will be 3.75%. Now, I don't know where that's coming from. It's assuming that we're going to see a substantial lift in non-mining investment. I really don't think that's going to happen, but they've got a lot of scope to adjust that without needing to cut rates. So the environment that would lead them to cut rates next year would be if they have a substantially lower number than the 2.75% in February, and if they slash their 2017 number, which at the moment is standing at 3.75%. I suspect that it'll be difficult for them to come to terms with slashing a 3.75 down to, say, a 2.75, which would mean you'd have to cut rates. But the story for Australia isn't as simple as that, in the sense that we are seeing a huge divergence across the nation. So if we look at state demand growth in the year to June, that's the black bars there. New South Wales, 3.3%. If you were setting interest rates just for the New South Wales economy, you'd be raising rates now. Victoria, 3%. And then if we look at the resource states, Queensland, minus 3.3%, Western Australia, minus 1.8%. So you've got this huge gap opening up between the southeast and the mining states. Now, policy has to be set for the overall economy, and that's why steady rates is probably the best way to look at it. Other states, such as South Australia and Tasmania, have been disappointing now for many, many years. So what are some of the key stories about the overall economy and the biggest puzzle? So if you look at the red line there, that's mining investment as a proportion of GDP. And this is your mining boom. So in the build-up to the mining boom, mining investment was about 3% of GDP. It peaked at about 8%. So the mining sector over that 10, 11, 12 period added 5 percentage points to GDP. After the GFC, non-mining investment was hit by a huge shock to confidence, and the non-mining sector cut their investment as a proportion of GDP from 14% to 10%. Now, the expectation has been that at some point, with low interest rates, GFC behind us, that the non-mining sector would start to lift that. And that's what hasn't happened. So we're now in this situation where mining is reversing and is taking growth out of the economy at about a 1% per year pace, and you're not getting the offsetting lift to non-mining investment, which has been extremely surprising, particularly for the Reserve Bank. That's the main reason why they've had to cut their growth forecasts. If we look at business confidence numbers and we look at the situation with reform, etc., and I give you feedback of the people that I talk to, it's looking pretty difficult to see how that non-mining investment number is going to lift. And without that not happening, it makes it very hard to get back to those sort of 3 and 4% growth rates. Once again, it does come back to the debt story. Non-mining sectors looking at the demand from the housing sector, from the household sector, and going, well, we're not seeing the demand that we want. It's also looking at its balance sheets and saying, well, we're very well geared, but we still would like to get that gearing down even further. So that represents one of the real challenges for the economy. One of the positives, undoubtedly, is services exports. And this links in with the China story very much so. Now, we're in the very early days of this, but if I was looking for the silver lining, the future for our economy, undoubtedly it's in that sector. So, for instance, if we look at the value of our services exports, they are now substantially higher than iron ore. They're not higher than resources combined, but they're substantially higher. So 2 years ago, services exports, when we had an Aussie dollar above parity, subtracted 0.5% from GDP. And if you're talking about 3% GDP growth, 0.5% is pretty significant. This year, they're going to add 0.5%. And of course, that's been the major benefit from the low Aussie dollar. Now, these are sectors such as health, education, retail, tourism, etc. They're the ones that have been, if you like, in the doldrums for so long, that are really generating the potential future growth. Because, as I said before, if China's rebalancing its economy away from industrial towards services, they're going to be wanting to import a lot of services, particularly through the tourism gap. And tourism in China now is a rapidly growing industry. Another sector that's done well out of this rebalancing is retail. You can see retail was growing at 6.5% nominal before the GFC. This was when Australians were driving it, when their savings rate was zero, they were using their house as their ATM, and retail benefited enormously from that. Then we got hit by the GFC. The Aussie dollar went to parity, tourism dried up, retail was hit by households worried about their debt levels, and it was a period of the doldrums. We've seen some improvement recently. I would say retail now growing around 5, which isn't back at the pre-GFC levels, but it's a hell of a lot better than they were used to in that period immediately after the GFC. And part of that is being driven by this improvement coming from the services export story. If we look at retail sales relative to household spending, a huge wedge has opened up. Household spending measures what Australians spend here and offshore. Retail measures what anyone spends here. Retail is a lot stronger now than household spending because of this swing factor associated with tourism. Another way to look at where the Australian economy is evolving is how is the extraordinary growth in jobs in the last 12 months. If you have an economy growing at a little over 2%, you don't expect jobs growth at 2%. If you have jobs growth at 2%, with a population workforce growth running around 1.5, you're actually able to bring down the unemployment rate. Normally you don't associate 2% growth in the economy with bringing down the unemployment rate. But this is what we've been able to achieve, and this is another factor that's keeping the Reserve Bank on the sidelines. So where have these jobs been coming from? Health has been the huge standout, and the ageing of the Australian population undoubtedly is going to mean ongoing prosperity and ongoing jobs growth in that health sector. Professional and technical has been a surprise. A lot of that is outsourcing. As the major organisations are given headcounts, they get rid of people, and then they need the work still to be done, so they outsource. Lawyers, accountants, very prosperous. They're prosperous day to day in the Western ballroom. You can see that the law industry, the legal fraternity is doing well. Engineers, architects, booming as a result of the Sydney building boom. A lot of these jobs are happening in New South Wales. So the professional and technical has been a surprise. Accommodation and recreation, undoubtedly related to the tourism story. That's where the jobs are actually coming from, and there's a few ongoing clear signals in there. The first one around construction, linking in with professional and technical. The second one around tourism, recreation and accommodation and food. And the third one around the ageing of the population and health. So they're three of the growth areas that are leading to the recovery in the Australian economy, particularly in our labour market.